Okay, so I'm going to go through the question that has been released recently by the examining team, and it's the March-June 2023 exam sitting. I don't know when this question came up. I think it may have come up in March, but it's basically an advanced variance question, and I actually think it's a nice one. So those who probably got this question were probably quite happy if they practiced. And what they've asked you to do is says for each ingredient, we use the soya bean and the sugar. So don't get distracted by the soya milk. That's what we're producing. We need to do price variances, splitting between planning and operational, and usage variances, splitting between planning and operational. And so these are the ingredients, and this is the standard cost card. And so we need 200 grams, which translates into 0.2 kilograms, at $5.90 per kilogram for soybeans, and 12 grams or 0.012 kilograms at $1.80 per kilogram. Now, you're better off working in kilograms because the cost is in kilograms. All right, so just be careful. You're better off working in kilograms because the cost is in kilograms. So what we need to do is set up what the price variance is and the usage variance is. Now, the price variance is the difference between the actual price and the standard price times by the actual quantity. So the difference there times by the actual quantity. The usage variance is the actual quantity versus the standard quantity times by the standard price. So you either can just learn them or use my sort of diagram. And what I tend to do is sort of put a triangle across the middle. So therefore, you know that you're taking for price, the two prices and timesing it by the top. And for quantity, you're taking the two quantities and timesing it by the standard price. Okay. I think somebody's just joined. I'm just going to stop the sound. Hi, James. So when we're doing this, they're asking us to go straight into doing material price planning and material price operating variance. So basically, you need to just now quickly read through the scenario and pick up the right things. Now, the one thing you don't do is pick up the budgeted production, all right? That needs to be struck through straight away because that has got nothing to do with those variances. We are always doing it based on actual production, okay? So always strike through the budgeted production when you're doing cost variances. The only time that you'll be using the budget is when you're doing sales variances, okay? Now, the standard costs obviously therefore need to be adjusted. The standard quantities need to be used by timesing that by the number of units. So the actual production is 480,000, okay, of soya milk. So we need to find the actual quantity used for sugar, and then we need to find the standard quantity that should have been used for sugar and beans. Is everybody happy with that? So the actual quantity is down here. So vegan used 94,000 kilograms of soya beans and 5280 kilograms of sugar. So there's your actual quantity. Don't overthink it. 5280 of sugar. All right. Now your standard quantities is given to you in terms of soya beans. It's 0.2 kilograms and 0.012 kilograms for sugar. Now we're going to convert that into a standard quantity using the actual production, okay? So we'll do that in a minute because it gets confusing otherwise. Then we've got our actual prices, and they've told us in November 570 was paid for the soybeans and 190 was paid for the sugar. So we've got 570 and 190. The standard prices are here, which was 590 and 180. It's picking up the information quickly and easily, all right? Now, we will need to read through the scenario a little bit later when we're doing the part B, which was the written section. So we will come back and just check these bits here, but basically to do the calculations, it's quick and easy. You just need to find the numbers, all right? So if I was just being asked now to just do the price variance, I would be doing the difference between the actual price and the standard price times by the actual quantity. But because I've now been asked to do the planning variance, I need to adjust these planning ones, these standards, to create a revised standard, so I can create a difference between the revised standard and the original standard to get a planning variance. All right. And then the difference between the revised standard and the actual is therefore an operational variance. So everybody's clear. So the market price in Zealand for soybeans decreased by 10% in November, but for sugar it increased by 20%. You never adjust the actual. They are fixed. Don't ever adjust those. In fact, I'm going to put them a highlight. You never adjust the actuals. You always adjust the standards because that's what we need to adjust. So they're telling us for soybeans, the market price decreased by 10%. So find that and then times it by 0.9 because you're decreasing it by 10%. But for sugar, it increased by 20%. So find it, 180, and times by 1.2. So those are your revised prices. Your revised quantities are down here. It said vegan has made a change to the standard mix at the beginning of November, reducing sugar to 10 kilograms per unit. So it's reduced that to 0.01. Make sure you put it in the same way. So 10 grams, which is 0.01 kilograms. And to comply with government legislation, that's pretty important for the written bit. Let's just highlight that bit. To try and maintain the consistency of the milk, vegan also decreased the soybeans for 200 grams per unit to 190. So that's now gone to 190. So 0.19. Let's see, I don't know why that's not working. 0.19. So I didn't adjust the standards, I just created the new standards. So those are the revised quantities. So I'm now ready because I've got everything in place to be able to now calculate my variances. All right. So this is now the material price planning variance. Okay. So I need the standard price. I need the revised price, and I need the actual quantity. So standard price for that, sugar, revised price for sugar, and then actual quantity for sugar. And therefore the variance for sugar is going to be, now the best way to do this is because you only have to then do this once, because you can copy it then, is to take the standard price minus the revised price and times it by the actual quantity. And then you need to put it as adverse. You need to tell the examiner it's adverse. And this is for sugar. Okay. Now we're going to now do this one for soybeans. So soya B, you don't need to write it out, but you can just literally copy that down because you don't want to have to do that again. That you then just slot in the figures that you need. So you can reference in the 590, you can reference in the 531, and you can reference in the actual quantity. And that comes out as a favourable variance. Okay. Now that makes sense. Let's just check that. The revised price has gone down, which makes sense, doesn't it? Because it says decreased by 10%, so therefore it must be favourable. But the sugar price has gone up, therefore it must be adverse. So we're happy with that. So that's the material price planning variance. It's up to you if you write it out in full, but it just takes time, as you can see. Material price planning variance. So I did it shorthand, but if you want to make it clear to the examiner what you've done, all right. And it says for each ingredient, it doesn't tell you to add it together, all right? So you have to do it separately. Now, what you can then do is copy that format and now just put it in again, and then just change it to be operating. Just giving you some quick ways of doing this. That now needs to be number 2. And so these need to be changed now because we need the difference between the actual and the revised. So that needs to be RP and that needs to be AP. That stays as the actual quantity. So you can reference that in above. And then you just need to put your revised prices in. So again, you can reference that to there. If you're using the same, you've made a mistake. These now become own figure rule marks. So if you've made a mistake on these revised prices, these ones then become own figure rule marks if you now use the same ones. So it's really important that you do these clearly and properly so that the examiner can follow it, okay? So that is now my sugar actual price, and that is now my actual price for soybeans. Now notice I'm always putting the standard first and then the actual second, yeah? When you do cost variances, as long as you do the standard first and the actual second, you get the signs the right way round. So with sugar, the actual price is less than the revised price, so that should be a favourable variance, and it has come out as favourable. But with soybeans, the actual price is greater than the revised price, so that comes out as an adverse. Okay, so that is 3 marks each. You're getting 1 mark for doing the calculation. You'll be getting half a mark for getting this adverse and favourable. So you must make sure that you're doing this correctly, saying adverse and favourable correctly, not just leaving it as a minus and a positive. All right. So those are the price planning variances. Now, again, I am going to literally copy this again because the format's there for me, and then just change the words. All right. So now we're going to change this to be number 3. And it's now going to be the material usage, actually planning. I need to change that to be planning. Usage plan variance. Doesn't matter about my spelling. So now you need to do the difference between the actual quantity and the standard quantity. So the quantity changes times by the standard price, okay? So this needs to be the standard quantity, the revised quantity, and this needs to be the standard price. Now, the calculation will still work, so you don't need to repeat having to do that, but you just need to change the numbers. So the standard price for sugar is 1.8. Make sure you use the same figures as you've used in the price planning variance, etc. The standard price. And now we need to come up with the standard quantity and the revised quantity. So basically, for sugar, the standard quantity is that times by the actual production. The revised quantity is the revised one times by the actual production. And the soybeans, the same, that standard times by the actual production, and that standard times by the actual production. Now, you know you've got to have a bit of a sanity check here. Look, the actual quantity is 5280. If you're getting something for the standards dramatically different from 5280, then you've done it wrong, haven't you? Again, with the soybeans, that's 96,000 and 91,200. It's similar to the actual quantity. If you're getting something vastly different, you've done something wrong and you need to be clearer, okay? You need to go back and check it. So the rule is actual production times by the standard, the revised and the standard. So there we have it. We already have therefore calculated the variance. You can see it's the difference between those times by the standard price. That's favourable. We need to change that to be favourable. And that's done as well. And so the final one to do now is the operating one. Again, just copy this down and then we'll change everything. That needs to now say number 4. This now needs to say operating. And we now, or operational, it doesn't really matter. We now need to just use the figures above as we've done before. So 1.8, 1 and 5.9 are still there because they're the standard price. We now need the revised quantity and the actual quantity, which is the difference between for the operating. So the revised quantity we've already got. Let's put that there. Reference it above because you're splitting the usage variance. And then the actual quantity, just make sure you pick up the right one, is there and finally there. So hopefully you can see it's all in the setup. If you set up your figures correctly at the top, then it's very easy to pull together the variances below, referencing your figures, and you'll get your answers all right. Okay, so that is fundamentally that 12 marks all done, all clearly labelled and followed through. Any mistakes can be followed through by the marker now. So for instance, if you've got the revised price wrong, then this one will be an own figure rule mark as long as you've done everything else correctly. If you've got the revised quantity wrong, then again, it's an own figure rule mark. If you get the standard quantity wrong and by not using the actual production, you'll get it wrong in the first instance here, but then it will follow through to the operating one, because obviously you will also be doing the same for the revised quantity. They should follow through your errors. So you do need to make sure that you're clear. All right. So that is the calculation bit. Let me now just go and have a look at the written bit. So it says here, assess the performance of both the production manager and the purchasing manager for the month of November. So clearly there's 4 marks going for each, but then they say there is up to 2 marks available for additional calculations. So actually there's 3 marks going for the writing for each and 2 marks for additional calculations. Now, if you write more and don't do additional calculations, I think potentially they would still give you more than 6. So, you know, if you can't think of any additional calculations, then don't worry. So what you need to do with this, though, it says assess the performance. It's quite systematic. You need to say as the starting paragraph, the purchasing manager is responsible for negotiating prices. But if you read down here, none of the above changes to prices and quantities were reflected in the standard cost card for November, which was prepared by the accounts department. It's the accounts department that do the standard costing, and it's only twice a year, despite both the purchasing and production managers stating it's not frequent enough. So clearly we need to be clear and say to the examining team that they should only be assessed based on price operational variances, all right? Because they're not responsible for setting the standard cost cards and in the standard cost cards. So they shouldn't be assessed on it. So therefore, we then go on to say, well, what has happened? Well, we're saying that the operational variance is adverse. This shows that the price negotiated was significantly higher than the market price. However, it's committed to use suppliers within 50 kilometers distance only. So this is an issue, and this is where we should have read this bit. The main ingredients are soya beans and sugar, both of which are grown within 50 kilometers of the premises. It's making it an appeal to committed caring for the environment. So popping that in the scenario means that they are having to have a higher price because potentially they're limited on who they can negotiate with. If you hadn't have made that point, then you would still have got the mark by just saying it's adverse, and so this is not good performance. Consequently, so then with regards to sugar, it was favourable. Whilst it's only a relatively small amount, it shows that the purchasing manager managed to achieve good performance. So that potentially is 1 mark, 2 marks for that one, and 1 mark for that one. All right, so you can get hopefully 4 marks out of that. You'd have got 3 marks even if you hadn't have mentioned this 50 kilometer distance only. Now, the next one is the production manager. The production manager, again, is a similar sentence to the above. Always state that they're not responsible for the standard cost cards, and they should only be assessed on operational variances. And for soybeans, this was adverse, and so they used more in production than they would have been expected. And this was the extra calculation. The extra calculation was, for 1 mark, is to say what they actually did use. Okay. The same goes for sugar. Again, the extra calculation was 11 grams. And it was actually important for you to note that it was 11 grams because there is legislation here. There's legislation here which says it should be at 10 grams per unit. So that is an important point to make. It means that soya milk now produced in November has too high sugar content. Now, you didn't need to calculate that because you know from the adverse it must have a too high sugar content because they've used too much. So overall, this reflects poor performance of the production manager and should be investigated. So this is a beautiful, I think there's more than 8 marks here because we've done the 2 calculations and we obviously made quite a few points. So you need to sit and think to yourself, I've got to make enough points for the 8 marks. And so you must be really clear about the fact that you're only monitoring the purchasing manager's performance and the production manager's performance based on operating variances. I would also give marks for saying why the planning variances were there. So you could say the planning variances were there because the market price, which is out of their control, decreased by 10%, and you didn't update the standards. And sugar was 20%, and you didn't update the standards. The planning variance was there for usage because of the government legislation to have 10 grams, and then on sugar, but on soybeans is they actually altered it at the same time. Here, it says here 20 grams per unit to 190 because they wanted to maintain the consistency of the milk. So you could have said that and also got marks for that. All right, that would equally be helpful because you're using the scenario to explain why there's a planning variance. So that is the perfect answer, but you can use my process, which is state what current performance is, state that they can only control operational variances, state why there's a planning variance, state why there's an operating variance, and conclude. That's the kind of thing that you need to follow to do this written bits in these sections.